Welcome to the 2% Club video newsletter, produced by Griffith Strayer & Evans. Griffith Strayer & Evans is a CPA firm who's teamed up with your advisor to share with you information about the strategies of the most financially successful small business owners. We prepare over 200 business valuations annually. This gives us an opportunity to study what the top 2% are doing financially with their investments, their business interests, their real estate, and with taxes. We produce these videos to share with you what we've learned from them in hopes that it will accelerate your success in joining the 2%. Today's topic will be owner compensation taxes, which falls under tax strategies that build your wealth. Consider the sources of federal tax revenue. Income taxes account for 47%. Everyone I know makes a concerted effort at tax time to minimize their federal tax liability. But payroll taxes, which account for 33%, very few people understand. Payroll taxes include owner compensation taxes, and this video will address the tools that we have to minimize your payroll tax obligations. Remember, we're not talking about federal income taxes, we're talking about owner compensation taxes. Owner compensation taxes can be referred to under multiple names. If you're a sole proprietor or a partnership, they're called self-employment taxes on your personal income tax return. If you're an S Corp or a C Corp, they're called Social Security and Medicare taxes, and they come out of your paycheck as they do with your employees. But what if you're an LLC? LLCs are a state entity and are not recognized by the IRS. The IRS does not have a separate set of tax laws relating to LLCs. So if you become an LLC in your state, the IRS requires that you tell them how you want to file your return. You can pick one of the four choices: sole proprietor, partnership, S Corp, or C Corp. You're also allowed to switch once every 5 years. So if you form an LLC and initially select sole proprietor as your tax entity, within the first 5 years you can change that to an S Corp, a C Corp, or a partnership, and you can also change it once every 5 years thereafter. You'll notice that the distinction between an S Corp and a C Corp only exists for IRS purposes and not for state legal issues. If you form a corporation in your state, you'll automatically be a C Corporation with the IRS, unless you make a special election to be treated like an S Corporation. So now let me share with you a real-world example of owner compensation taxes in action. A sole proprietor came to me several years ago for investment and financial planning advice. They'd been a sole proprietor for over 12 years and had $100,000 of annual profits. The strategy was to change that person to an S Corporation and to pay a reasonable wage to the owner as required under S Corp rules. In the sole proprietorship, they had $100,000 of profit. In the S Corp, however, they would split that $100,000 into a $50,000 wage and a $50,000 profit. In the sole proprietorship, Social Security or self-employment taxes of 15.3% would apply to the entire $100,000, resulting in self-employment taxes of $15,300. In the S Corp, however, Social Security taxes would only apply to the $50,000 wage, resulting in payroll taxes of $7,650. The tax savings is $7,650 per year. To summarize the results of this strategy, profit after wage is free of Social Security and Medicare taxes. The effect is $7,650 per year in tax savings. That same $7,650 per year invested for 12 years at 8% would result in $155,820 of savings. Money that could have been saved from a tax strategy that builds your wealth and used to develop investments outside your business, but in this case was left on the table and disappeared forever. The good news was that the $7,650 savings repeats every year going forward, and this person still had 20 years left in their career. $7,650 a year invested at 8% for the next 20 years would make $350,000 of savings and investments developed outside his business. The impact of this strategy multiplies in a partnership. Take, for example, a 3-person partnership we converted who would save $9,180 per year per partner for a total of $27,540 of total savings per year every year by converting this partnership to an S Corporation. For those of you who are already an S corporation, this doesn't mean that you're automatically taking advantage of this strategy. In many cases, the owners of S corporations are overpaying their wages. Here's another example where The owner's actual wage was $90,000 a year. The reasonable wage analysis came up to $60,000 a year. By reducing wages by $30,000 and taking distributions of profit in lieu of wages to make up the difference in take-home pay, this owner saved $4,590 total savings every year going forward. So in winding down and bringing this newsletter to a close, I'd like you to know that if you're not an S-Corp or an LLC designated as an S-Corp, there's a 99% chance that you should be. When managed properly, an S-Corp will save you taxes compared to all other entity types. My goal here hasn't been to teach you how to manage payroll taxes and owner compensation yourself, but to give you enough information so that you'll know when you do need to call and discuss it. Some other circumstances that might occur where I would encourage you to call are you're having a bad year in your business. You're buying a building for use in your business or doing a major renovation. You change to a part-time employment status with your company. An employee in your company makes more than you, or you're not an S corporation. A reasonable wage analysis for use in compensation planning is always done as a part of any business valuation. Compensation planning is a tax strategy that builds your wealth. It also provides funds to develop investments outside your business. An S-Corp is ideal when you're ready to exit, and an S-Corp is superior to both sole proprietor and partnership in protecting your wealth. So if you'd like to see if you can benefit from the information shown in this video, contact us and ask for a reasonable wage analysis for compensation planning purposes. No matter what kind of entity you're in, we can help you to minimize your payroll tax obligations. Please contact us to discuss your specific circumstances before acting on any information contained in this video. Best of success on your road